What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey. Welcome back. Steve and I are excited to have Jake Oubina back on the podcast. Jake is a managing director and deputy head of economic research at Piper Sandler. Jake and I often market together. We get to debate with clients and as well as debate each other sometimes. We continue to have a very similar view on the macro outlook. And in today's conversation, I'm excited to talk about everything from oil prices, interest rates, AI, employment, private credit, and everything else that investors are debating currently about the macro outlook.
Through this whole Iran conflict, this whole lifting of the left tail in terms of growth expectations, it's degrowth expectations, et cetera. We've been steadfast in our 3% real GDP for the U.S. economy this year. And we drew the line on, if you don't get $150 oil for 6 months, we're not backing off of that. And we never believed that the gas tax was going to be that impactful if we were just talking about $100 to $125 oil. And we're back to, what did we think on February 27th, essentially, in terms of the U.S. macro backdrop?
Yeah, that makes perfect sense given where we are now. So what's some of the data that's coming in the recent few weeks that reflects post-February 27th oil prices and interest rates that you've seen that's caused any concern? It was definitely that UMISH sentiment data that hit an all-time low, but at the same time, we've gotten some good data too. So what do you expect from the data in the coming weeks and months, and what would make you change either way?
Yeah, so I think the biggest impact, and you guys have been super focused on this too, because it's an important part of your framework. I think the biggest impact has been on the housing data in terms of rolling that over. We had a nascent recovery there happening through February, and you saw it in all the kind of weekly statistics. You saw it even in kind of the wallet share of consumer spending that was dedicated to home improvement. That started to actually perk up. It'd been dead in the water for 2 years. And you had the manifestations of a housing recovery. Now we've been in the U-shaped camp. We're still there, not the V-shaped camp, just because affordability is glacially improving here. But it was happening, and then you got around, and I think not only did that impact housing because of the rate backup that you had in treasuries and kind of this interpretation that an oil shock is inflationary, the completely wrong interpretation, in my view. I mean, we can dig into that if you want. But you had the backup in, say, like the 10-year, which obviously mortgages are sensitive to, but you also had a widening of mortgage spreads to the 10-year. And that was a function of volatility in the rate market that spiked as well. So the MOVE index got to 115, which is exceptionally high. And so to me, the most important thing you have to look at for now, a reversal of this and getting back on track with that housing improvement, is rate volatility. And rate volatility will continue, and it has in the past, dictated mortgage spreads very well. You could stay above 4 on a 10-year, you can hug 4, and you could still have your mortgage rate come down to 5.5 just on the basis of mortgage spread tightening. And that coming as a function of rate volatility. So I love the MBA weekly statistics, the purchase apps, the refis, but I think vol in the rate space is actually a leader even into that, because I think it tells you a lot about where mortgage rates are heading. And guess what? The MOVE index was back down to 65. Yeah. It was about 60 before the Iran conflict, which is relatively where we were pre-COVID. And again, if all this stuff sticks, it's going to head right back down there or even lower over the subsequent couple of weeks.
I love that you brought up the MOVE index, because I've been in this week, our video on Friday, I highlighted essentially why the market is bottom. Because like you said, we've priced, the tail has gotten thinner. It was really fat a few weeks ago. And you saw that you didn't see it in the price of oil as much as you saw it in the volatility of oil, both realized volatility and forward implied volatility. And you saw the same thing in the bond market. And I was actually looking at the MOVE index today, because for any of our listeners here, if you want to see one of the reasons why uncertainty has gone down, or an illustration of that within interest rates, look at the MOVE index and look when that peaked. That peaked right around the market bottom, the end of March. And like you said, it's come crashing down. And so we think about, is the market rebound here justified? If we look at measures of uncertainty, whether it's the VIX, which peaked at the end of March, bond volatility, the MOVE index, which peaked the same day, and then realized or implied oil volatility. All 3 of those measures across 3 different asset classes hit its high. And I think it's safe to say uncertainty hit its high. And while oil prices still elevated somewhat, the improvement in the market, the first, like you said, yes, the price coming down is good news, but it's the uncertainty that comes down first. And so I think there's actually decent parallel with what you said about housing and what's going on right now with the market and oil prices. And it makes me also think back to, and I'm sure you've had these debates too, because you guys have been more positive on housing as well. Yeah, the affordability issue, it's a glacial issue. If we're going to wait for that to completely heal, you're going to miss the boat. And it's incremental healing that we've seen in both the housing sector and more recently with respect to oil equity markets and credit and bond markets. So I think there's actually a decent parallel there. Now, what do you expect to see from the housing data? And in the last few weeks, we've seen purchase apps come down a little bit. Seems to be just reflecting the increase in rates. Now, with rates down, how important is it that we see purchase activity rebound?
Yeah, that's the second leg here, right? It's the mortgage purchase applications dovetailing with what we're seeing in rate vol. That's the sequence. And you get that lift, and that's it. That's going to transmit into higher existing home sales, higher pending home sales, all things that, again, we're starting to percolate before we're on. And if you look at even the glacial improvement in affordability, it's already consistent with existing home sales going to something like 4.5 million, which historically is not a huge number.
Yeah.
But we're at 4, right? And so rate of change wise, it's pretty significant. And when you free that up, you get that churn moving up. You get all the things that are tied to housing churn that, again, have been beaten up on the consumer spending side, furniture, appliances, home improvement, all this stuff where the wallet share has just stagnated or gone lower in the last 2.5 years, 3 years. And all that starts to work again. But to me, this rate vol coming down is a really important indicator. And by the way, the economy outside of this very directly impacted space where we did see a softening, the economy was doing very well ahead of the Iran conflict and continued to do so even throughout. You guys talk a lot about the PMIs, and I couldn't agree more. And I think regional PMIs have been in recovery mode for 6 months now. It's not just the ISM breaking above 50. That's just the latest bit of this, but it's the regionals that have been telling you that this was in tow for some time now. I am a huge proponent of, I think tariffs had a lot to do with that. I think you look at the effective tariff rate, it peaked in September, October. You look at the manufacturing complex commentary on tariffs, and it's like bad for employment, bad for orders, bad for transparency on price, bad for everything, right? Creating all sorts of problems with expectations and the like. And so I don't think it's a coincidence that you peaked in your effective tariff rate, setbacked, and you came down very sharply, especially in the wake of the Supreme Court decision on IEEPA, which you're now at 7% effective from a peak of 14. And that the manufacturing space, the logistics space, which, by the way, you're also seeing it there, the trucking demand numbers through the roof, right? Back to 2022. So we've had this like industrial logistics manufacturing recession, which was like 2.5 years in the making, really led by the Fed tightening cycle, which is super sensitive to that. And then they got whacked with tariffs as the Fed was easing and providing some relief. And so the recession continued. Now I think you're seeing the relief valve open from both ends, from lower tariffs, which were the nearest headwind, to the lags of the Fed that's been easing for some time now. And I'm very constructive on that part of the economy leading us in terms of growth out of here. And that has implications for, and I know you guys have done a lot of work on this, tying it back to EPS, but we've tied it back to employment. And I think it's no accident that you're seeing employment green shoots now. Claims are incredibly low. Continuing claims are coming down on a week-to-week basis, every single week. You're starting to see the hiring side perk up. ADP employment, and we're not leaning on this number a lot yet, on the weekly ADP number, because there's not a lot of history, but you have to pay attention when the weekly average is 40K. This number reflected massively in the last week. And so I think we are out of this no hire, no fire modality that we've been in for really post-Liberation Day. And we're now moving into a higher no fire backdrop where when you think about break-evens on employment because immigration's been throttled and supply is down, you could take a very quick drop in the unemployment rate and a perking up of wage growth. That doesn't have to be inflationary, by the way, as you move through 26. These were things that were in tow before the Iran conflict. There was a risk that you were going to throttle these, although you didn't because we had a record high in Empire, a nearby record high in Empire this week. Philly, which stayed in the mid-50s. It wasn't happening yet, but there was that risk. Now, if we're chopping that tail risk off, that's huge. That's more catalyst to what's already been in tow for the last 6 months.
So when you talk about employment, for me, that's one of the key measures I've been monitoring with respect to where the long bond is going to go. And potentially certainly a variable that's going to impact how the market thinks about Fed policy going forward. So you sound very optimistic, and certainly, I go back to my hope framework. We've seen some incremental housing improvement. PMIs are the strongest in 4 years, and I agree with you that I think people underappreciate what it took to get those things going, and that oil going up 50, 60, 70% is not going to stop that train. It's not enough. Going back to your comment about, let me see $150 oil for 6 months, and then we can think about a real sustained downturn in the economy. With respect to employment, obviously, a lot of the conversation has been about immigration over the last few years. So can you speak to how that, assuming that we don't see a big shift in immigration policy, how that plays out with what you just said with respect to hiring plans picking up and wages?
Yeah. So I think a couple of things there. One, I have a feel, and I'm not gonna make a policy prediction. That's not my bailiwick, but I have a feeling that the administration is going to go about immigration as they've gone about tariffs, which is to say a quiet de-escalation. And there was an article in the journal a couple weeks ago that got completely ignored, where the administration is very aware of that. The crackdown on immigration is already having effects on specific industries. They mentioned farming in this one in particular, and Trump is keenly aware of that. I think they're hearing it from the grassroots that this has become a problem. And I forget the woman's name who was head of the department there. Her being out is a huge deal, as I think is a pendulum swing. And so I would imagine that we get quiet easing of that policy as you go through the balance of 26 into the midterm elections in particular. I'm going to make a huge call on that, but whatever. I think they're treating that like they've treated tariffs. Immigration has not been, in this throttling of immigration, which you've definitely seen. You look at the numbers, you've had a throttling down in labor supply, for sure, no doubt. But that hasn't been the reason why employment slowed. Employment slowed because the demand side slowed. And I think the reason, again, tariffs. You were annualizing a $400 billion at the peak. Companies were paying the entire tariff. It was a huge margin compression story for them if they didn't throttle employment, which was the easiest thing to throttle. And so all these narratives like immigration is suppressing job growth, AI is suppressing job growth, all those were just like made under an environment where it was really all about tariffs and this margin compression risk. Look at all these things now. All these themes have fallen apart completely. The AI theme in particular, the 20 to 24-year-old unemployment rate moving up in the back half of last year. AI is killing entry level. Look at this, right? I was arguing, no, if you're going to throttle employment, entry level is the easiest, lowest hanging fruit. If you're a business, right? Yes, naturally, they're going to see more pressure in that environment. 20 to 24-year-old unemployment peaked at 9% in September, October. Yeah, huge. Oh, AI is killing jobs. It is down to 6.5% in March. It came down precipitously over the course of the last 6 months. Okay. The spread to the overall unemployment, which was another thing that kind of the AI doomers were using as evidence of AI killing jobs and entry-level people. The spread to the overall, the 2024 spread to the overall is at a 57-year low. It's a staggering,
incredible.
Okay. And so that thematic completely fell away. I don't think it's a coincidence that, again, tariffs peak in September, October, all this stuff magically starts getting better. Not a coincidence. So immigration going forward, though, will matter in the sense that you have potential in an environment where hiring is picking up. And if we're going to be doing 50K, 60K, 70K, which historically is not that impressive, but on a break even that's somewhere between 0 and 40, that is a recipe for the unemployment rate coming down very quickly. Yeah, so you throttle the supply side, but the demand side is now all of a sudden perking up.
The recent paper the Fed just published, didn't they say 0?
Yeah, they had 40. Yeah, they had a range in there. My number's around 40.
Yep.
In either case, you're doing growth that's significantly above that. The unemployment is just crashing in that scenario. And wage growth is starting to perk up, which it hasn't been. Wage on a marginal basis, on an hourly wage rate, et cetera. Overall, aggregate wage growth has been okay. Average earnings have been in a downtrend, et cetera. All this stuff starts to improve, and the organic piece of growth to the economy starts actually getting better as you move through the year.
Okay, so with that, going back to how I initially posed this question, how do we keep rates down in that environment?
I don't know that you need to keep rates down. And I agree with you on, you've talked about this the people being of this modality of inflation, right? And And we're fighting the last war on that, and we're very worried about inflation. I think the Fed's in that camp too, which is why they've been more hesitant to call the oil shock a growth shock and like taking both sides of it on this. Where historically we had this oil shock, they'd be very worried about unemployment going up and articulating it that way in a very dovish way.
Mm-hmm.
But yes, we're fighting the last war. I actually think that if rates are going up, and you're seeing this when you look at the 10-year, it's been more about the real rate than it has about the inflation premium, because even with the oil shock, the market inflation premium really only went up in the front end, didn't really go up beyond a year out, which I think was the right interpretation. If there's more growth premium in rates, the economy's growing faster, potential growth is increasing. That is not a reason to hate higher rates. And thinking about that from a company standpoint or from an earnings standpoint, if you're growing your rate of cash flow growth, vis-a-vis better economic growth, or nominal GDP, if you want to think about it in the overall economy, yes, your discount rate is going up for your kind of free cash flows, right? If you're discounting the back, but it's much more important that your growth rate is going up as well. And you saw this in the 90s where taking out all of the tech stuff that was happening, you had an increase in potential growth because productivity was actually doing very well. And rates had to account for that. And so despite that, you could still get really good market performance. It's a balance of to what degree are you taking the discount rate up relative to what degree are you marking up growth? And it's a dance that you do. But if the reason the 10 years at 450, let's say by the end of this year, is because we were running 6% nominal GDP growth, perfectly fine environment for the economy, for markets, et cetera. But I think that I agree with your point on that vis-a-vis the sensitivity to rates that was, I think, introduced through this dynamic of inflation over the course of COVID and a hypersensitive, and almost forgetting that there's two things that are very important to drive rates, which one being growth and the other inflation, taking out all the kind of firm premium stuff.
So for the market, for me at least, I guess that could mean that could put a bit of a ceiling or a cap on the ability for valuations to keep moving higher, like they did in 23, 24, and 25 as the Fed cut rates and mortgage rates in the long end came down. But like you said, if it's because demand is increasing, the ISM is if the ISM gets to 60, I'm okay with a 4.5 to 460, 470 10-year yield, because anything I lose in the multiple, I'll most likely get it back and maybe then some in the earnings component. And then for housing, back to your point, in an economy that's broadening, and again, yes, we're in a glacial K-shaped economy that's not necessarily going to get solved by a cyclical recovery, but perhaps you could also get some more incremental policy coming out of the Trump administration, or just reduction in the mortgage spread, which we did see offset a rise in the long end late in 2025. And there's still plenty of room for that to come down.
Totally agree.
Any kind of risks on the horizon?
One thing that comes up a lot, so in terms of risks right around this call, I think the energy one was obviously the big one, right? And we'll see the duration on this. Again, to me, and this is where the pricing of all this is important, because I never thought we had a big energy shock problem given what had transpired. I think, again, we had to go a lot higher there, but the pricing in of that problem was significant. And so I think that's a huge swing factor now in terms of what people are thinking about in terms of the risks. And it's tied to a few things. It's tied to the gas tax kind of eating away at the household refund story. So we know refunds in the US are a lot higher than last year. More importantly, and Don's been making this point, non-withheld tax payments are way lower this year, because if you paid taxes last year, you probably paid a lot less this year, right? And so that's also important to track. It's not just about refunds. You take all those things together, and I think we're doing something like 70 billion versus last year. Totally on track to hit Don's estimate of about 100 billion when all is said and done here. One of the risks around that was gasoline above $4. It's eating away at this thing. And the point there was, we're annualizing these tax refund numbers. And everybody seems to be annualizing the impact from gasoline prices, right? If you look at the actual impact from gasoline prices, keeping demand steady for gasoline, like starting right before the war until where we are today, at about $4.10 a gallon. We were about $3 a gallon back then, and accounting for every day incremental, it's about $13 billion in terms of the overall lift and hit to the consumer wallet. On, again, 70 billion of about in refunds in terms of the not withheld and higher refunds. So a fraction, right? Now, I think the lower 20% obviously gets disproportionately hit by that because they don't really get refunds. They don't really pay withheld taxes, and they spend about 7% of their money on gasoline, which can go up very quickly if prices are up. So that point was taken. But I think there was a huge extrapolation in terms of magnitude of the gasoline shock offsetting the refunds. I think that's going to come completely out now. So that's more of a positive risk, I would say. And looking at what wholesale prices have done today alone, or recently, they were up highs. They fell almost 10% on the recent Iran news. And so they're telling you, we're going to be back below 350 in a couple of weeks if nothing changes on this front. If this is real, if this improvement in the geopolitical sphere is real, we'll be back below 350. And all of a sudden, we're going to be talking about the consumer maybe then accelerating in the second quarter on less of a gas tax. To me, that risk is being put to bed. The other one would be, and I think it's going to come up a lot more as we get closer, but the re-escalation of tariffs, which I don't agree with. The administration continues talking about it. 301s, they've taken 232. They don't talk about 232s anymore, interestingly, but now 301s and saying that we can get back to pre-Supreme Court tariff rates. I think that is a risk that we have to be mindful of, something for July, because Section 122 goes away in July. And then all of a sudden the effective rate falls to 4% if they don't do anything from a peak of 14 and a current 7. I think by the way, I think internally, I think they're very happy to see that happen. The guys that actually understand how tariffs manifest in the economy. The fact that tariffs were probably the number one reason why employment growth slowed, and the de-escalation is the number one reason employment growth is accelerating. And so I have my doubts whether they will re-escalate. It's a risk. It's a huge debate, I'll tell you, when it comes up. And it came up a lot more before Iran made up all the energy in the room and the oxygen. But I think it's going to come back to the fore as a narrative and as a risk. But the question I asked for the people that are in the re-escalation camp is, why didn't the administration do 15% on Section 122 when they could have? They did 10 instead. They've been actually throttling down even before SCOTUS made their decision. And so leading up to the midterms with affordability is a huge topic. People tie tariffs to prices, to affordability. I think it's really hard to re-escalate. I think they're very happy to quietly de-escalate on that thing that is effectively a corporate tax cut in my.
So you guys talked today about how GDP in the first quarter, not surprisingly, is going to come in fairly soft. If we continue to see things go the right way, and what I mean by things, oil prices, interest rates, stock market, how strong could the rebound be in the middle of the year?
Yeah, and part of this is the math around the energy shock, right? Because part of the reason that 1Q GDP is being throttled down is because you had headline inflation. It just goes through the roof in March. You're going to still see a little bit of that pressure in April, although that's coming down by the day. But then once you get into May and June, if this is done and we're going back below 350 a gallon and maybe towards 3 again by the time June rolls around, you're going to have the opposite effect. You're going to have an artificial lift from the deflator actually getting crushed and real growth actually moving up because of that. So you had inflation go up a lot on the headline basis toward the end of the first quarter. That's dampening real growth. If I look at this stuff year over year, though, the consumer, our kind of weekly tracker on consumer spending, we roll up all the credit card data by company, et cetera. We were accelerating throughout the Iran conflict. We were almost 5% year over year in nominal terms through the first week of April. Even if you throw a 3% inflation number on, that's still a 2% consumer. All things said, with this inflation headwind, that's still pretty good. But that goes up. That goes up to 4 in second quarter. And you're going to be realizing a lot of this tax refund, lower withholding money, which maybe there was some hesitation to spend as much as you would have because you were concerned about the markets and the Iran conflict, et cetera. Now we're sitting here today with a record high on the S&P at last look anyway. And there's no pressure on household balance sheets anymore. And so I think, yeah, I'm totally on board with a re-acceleration in growth and a lumpy looking GDP profile because of the way the Iran conflict manifested in headline inflation.
Now, in terms of interest rates, let's talk about the short end of the curve real quick. I think you guys have been saying for a while here, we don't need the Fed to cut anymore. And listening to you, it doesn't sound like a backdrop where the Fed's going to certainly not rush to cut. Maybe they'll squeeze a cut in there, but it sounds like you guys do not expect a cut. How important is what the Fed does going forward? And we're getting in the next couple of weeks, I imagine, the Fed's quarterly senior loan officer survey lending standards, which is also a great reflection of how the economy is. They've been loosening on net, or the tightening that we saw a couple of years ago has certainly come off, and they're starting to move towards somewhat of an easing. How do you see that transition taking place? And is that more important than the Fed cutting rates or keeping rates stable?
Yeah. So I don't think 25 or 50 basis points is neither here nor there. And I think that's where most people's heads are at. No one's in the recession camp looking for massive cuts. No one's in the inflation on a core basis is moving up and is going to be here for a while, and so they have to hike. No one's having really these conversations. It's really the dance around nothing this year, or maybe they cut a couple of times. I think it's totally possible that they can get a couple of cuts in. I don't think that, again, I think you articulated it right, that the growth backdrop will warrant that. But can Warsh get in there and convince the committee that we have this productivity miracle in tow that's going to be massively deflationary? And why not? Why not take a couple of cuts? You could also make an argument from the K-shaped standpoint, whether it's for businesses or for households, that lower rates would help the lower part of the K without really adding much inflationary pressure from the credit side, because the vintage data that's sitting out there is sitting at very low rates, right? Yeah. So neutral, which is a weird concept to begin with, neutral, when you think about vintage data that's sitting out there, vintage debt that's sitting out there, might actually be pretty low in the current environment, right? The average mortgage is like 4. IG is at super low rates in terms of the stuff they extended during COVID. And so I think it's probably going to take a lot to actually get an inflationary impulse in the market from lower rates. You could benefit the lower part of the K. They haven't made that point, but it's something that if they articulated, I think would have a lot of mileage in terms of trying to promote more cuts. So they could get there. Again, growth doesn't tell you you're going there. But yeah, on the lending, again, same thing, right? So you have this lagged effect of the cut cycle. You've got the economy looking better, and you have bank lending that it's not just the surveys, which tend to lead actual activity, and they have been moving up now for some time and telling you, look, there's a real lending cycle here. As small as it might be, bank lending was dead in the water for some time there, and now it's inflected positively in a good way. And I think, that'll return dividends to the economy as well. And do you get a bit of a hiccup there? I don't know how much the uncertainty around the Iran conflict will get picked up in a survey like that in terms of willingness to make loans and tightening or not tightening. But I think the overarching thematic there was already one that was very positive for lending, ergo positive for more economic growth. And you're right back there if again, this resolution is real on the geopolitics.
You touched on AI, but obviously it's driving the market, a huge theme of what's been going on, at least structurally. How do you guys think about AI with respect to your macro outlook and your models? I know you guys have been bullish on CapEx. You've talked about that broadening out. Give us a quick update on that, your thoughts there.
Yeah. So first on the employment side, I don't think, outside of anecdotes that we can pick and choose a ton of, I don't think AI is having an impact on the job market. And maybe this is a yet, and maybe it's coming. That's totally debatable.
Sure.
There's a survey that BA does weekly in terms of AI plans by sector, AI usage by sector. And they ask companies basically on the plans in the next 6 months, how much is your business going to engage in anything related to artificial intelligence, whether it's machine learning, natural language processing, agents, even as rudimentary as like voice recognition, right? So all a catch-all group. So pretty wide capturing AI, right, as a group. So AI plans, you line that up against job growth by industry, by the same issues, zero correlation over the last year. Zero correlation with AI usage and job growth as well. So that's taking the macro view of this. Some of the interesting parts where they've been heavily debated. So software, huge debate on the displacement there. And look, I'm sure there's companies that you can find within the software space that you can onboard an AI solution and basically get rid of that as a thing. I don't think that we are yet at the point where we're vibe coding like enterprise software that has all kinds of other challenges and edge cases, unless you can hire a gigantic software team. And I take those points that have been made there. But I look at the labor market there too. Software development job postings, they bottomed at this time last year, and they have been up and to the right since then, and they've actually accelerated in 2026 sharply. The layoff cycle in tech, which occurred circa 22, 23, we're now having revisionist history about this because we're saying, oh, that's when ChatGPT came out, and look at all those layoffs. It was the Fed tightening cycle that led to that. It was unprofitable tech that had problems when rates went up. Right. And so back then we knew what it was and we talked about it, 200,000 plus in layoffs in the tech sector. The Fed just hiked 500 basis points. What did we expect? And it was pretty clear. And I think that's still right. And that's why software development, again, the Fed starts cutting and lo and behold, the lag, that starts perking up again. And tech employment starts perking up again. Wages in the software publishing space are running 7.5 to 8% year over year, average weekly earning, which is 2 to 3x kind of the base rate of the economy right now. That is not a loose labor market for software development That is not a AI displacement of software developers. In fact, if you've increased demand for in-housing software solutions, it's going to be a great environment for software development employment. And so do this read through on the short-term stuff. You have it in other areas. You have it in legal where, again, it's supposed to be a huge AI displacement. Legal jobs continue to make new highs every single month. My point is, you look through history, when you make something that people desire cheaper to deliver, whether it's a good or a service, you get more demand for it. And more demand means more labor, actually, in that space. Mm-hmm. And that's been how things have played out. I don't think it's going to be very different with AI. And I think thus far, that's proven to be the case. I think there's a whole other conversation on AI, and I think this anthropic mythos model, I don't even know if that's how you pronounce it, but that's a whole other can of worms. And that's just exposing a threat of the technology that's important to take on board. Totally different conversation from the employment displacement trade. And I think something that we need to be aware of.
So it may not be different this time.
Certainly not from technological revolution and the way it manifests into employment markets. I don't think so. And the proof is that thus far it is not.
How about one last topic of risks that comes up in a lot of conversations that I have with clients, and I'm sure it comes up with yours because you guys have written on it quite a bit. Private credit. How, in your thinking through your lens, is that currently impacting things? What's the potential for it to become more systemic? And are there any pockets of the economy where you see it having a more of a negative impact? And you talked about business lending, talked about consumer lending, a lot of innovation still taking place. How is that impacting your views?
Yeah. So the way I think about it in general, right? And I think obviously there's been some impact and I think it's largely this AI destroying software and pockets of the tech space that are vulnerable to AI, where you've got business development companies that have lent out a lot of money to these kind of budding tech companies. And maybe now they're not going to realize that type of cash flow in the, there's something to be said about that. But as far as all the things I read on what the private credit stack looks like, the exposure of software seems to be pretty small. And it seems to be a subset of a subset where the real issues are. Again, the data transparency is not great in the private credit. It's private, right? And so we don't have total visibility there. But to me, the private credit market should unfold just in a general sense, much like what you're seeing in the public credit markets. And so if it's an economy that's actually improving, spreads are tightening for a reason, right? If there was uncertainty about geopolitics, the spreads widened a little bit, especially in kind of the junkier spaces. And I don't see any reason why that space should behave any differently with respect to its sensitivity to the economic realities.
Yeah.
And if the economy actually looks fine, I don't expect that to be an issue. And then the other part is just the size, right? And the systemic nature of it. We're not talking about housing circa 2006, where you had 35 times leverage on these things and a $10 to $15 trillion market. I think it was an investor that made the comment. It might have been at a dinner we did recently, Michael, but the entirety of the private credit market, you can absorb it in a couple of days of S&P performance to the upside. And I think it's important to keep magnitude in mind here. And yes, painful if you're exposed to those areas that, again, are being disrupted for real and where the solutions are real and can displace a lot of this stuff. But the further you zoom out from that, the less of a concern it becomes, I think.
Yeah. So the theme I'm hearing from you is that there are a lot of things, when you think about risks, that are ultimately a reflection of K-shapes, whether it's the consumer, businesses, private credit, where you just said, would you agree that there obviously there is some pain going on there, but it's not necessarily reflective of the breadth of total private credit?
Yeah. And that's the sense that I get from listening to the smarter people on private credit.
Yep.
And we've had some deals in the private credit space go through recently where whole tranches of bonds were bought. And I'm sure everybody's seen the headlines on this stuff. And this is not an environment where seems an environment where people are trying to find opportunities in a market where we threw the baby out with the bathwater, more than an environment where we're worried about marks coming in lower, T plus a quarter or 2 quarters, the way we were back in the subprime days, where we just kept marking down the portfolio.
Sure. I'm sure you would agree with this. K-shaped anything becomes exhausting because it's so easy to cherry pick data points and find data points that are either super negative or super positive. So you can have bull and bear debates all day, all night.
And I think the problem with the K-shaped as well is you're looking at something that is fundamentally a market cap based system, and you're trying to give everyone the same vote when you articulate it in the K-shape. So we see this with consumer, right? Because the upper 20% do most of the spending in terms of growth, et cetera. And the lower 20 does less than 5% of the total pie of consumption. And yet the K is like this big, ugly thing. But when you adjust it for magnitude, the top line of that K is actually quite large from a market cap standpoint. The bottom is small. And we did the same thing with the businesses where, yes, there was a recession in small business for 3 years in the midst of the Fed tightening cycle. But corporate America did quite well, actually. And the economy overall did quite well. The GDP is a market cap weighted metric. It's not. And so you had sentiment metrics that are not market cap weighted do poorly, and you had small business do poorly. The bottom of the K do poorly. I think we lose sight of that more proper market cap weighting when we think about talking about nitpicking little things like you said in kind of the bottom of the K. And I think we're probably doing that with private credit a little bit as well. I agree with that.
Very informative. I think the way you guys are looking, it's very close to us, but you're coming at it from a different angle. So it's great to hear, and looks like the market continues to agree. And that's where the buck stops.
Totally agree. Thank you, guys. Always a pleasure.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.